I want to offer you, first of all, today, a book totally free. It's the book that I've based today's material on. It's called Succession Planning and Exit Strategy, no surprise there. And to receive a complimentary hard copy of this book, just type "book, please" into the question panel at any point during this morning. Or if you can't find the question panel, just email me, david.oliver@bcms.co.uk. So that book, of course, will be complimentary for you. Just let me know if you'd like that book, please, into the question panel. Now, the material today has been drawn from International Mergers and Acquisitions Advisor BCMS, Jonathan Dunn in particular, who's got a wealth of experience in succession planning and exit planning. It's also drawn from Investec Wealth and Investment and from law firm Harrison Clark Rickpeas, who teamed up together to provide us with the core content, the foundations of today's material. And it will look at how should owners decide whether to sell to a trade buyer, organize a management buyout, or keep the business in the family. And in this material, in the book as well, which of course you're welcome to, as we've just said, your clients, business owners, are presented with impartial advice on the many different options available to them, from how to identify a potential successor internally to designing an exit strategy. And making these decisions early will help ensure that business owners can pass on their business, if you will, without compromising its value. And I was reflecting on this fact recently. I hit my 65th birthday at the end of August, and it's a big moment. It makes you reflect. It makes you reflect when you draw your first pensions check. I can tell you it didn't go that far. But of course, on a serious note, or at least a slightly more serious note, these moments in life make you realize, or remind you perhaps, that you're closer to the departure gate of life now rather than the check-in desk. And I think that quite appropriately forces certain thoughts and perspectives to be reevaluated. But it got me thinking about today's material, because the fact is, even if we don't talk about it much, often the reality for our clients, and for us, by the way, we can't fit our business into the little box that completes our time on earth. Sooner or later, the reality is we will either wind it up, sell it, or find a way to pass the business on in an appropriate way. And having consulted many hundreds, probably thousands, of business owners on this issue, one sobering fact stands out at this point in our material, and it's this: I have not yet met anybody who deeply wished they had sold much later in life. I have conversely spoken to hundreds who deeply wish, some of them very deeply wish, they had thought this through and worked this through earlier in life. So I'm hoping this material, in some small way, will enable you as accountants and advisors, in turn, to serve your clients well by having informed conversations with them. Today, I hope will give you great content from respected sources. Importantly, it's going to provide you with the book that you can then give to clients. By the way, I will give you a PDF of this book as well automatically, so you can send that PDF to your clients. And most commonly, its use will be to initiate the appropriate conversation with clients for whom that conversation is right, or at least give them the opportunity to read, reflect, and then respond. So we're looking at material to help accountants and advisors, in turn, help their client, business owners, protect the value of a company during a change of ownership. And the decision by an owner-manager to step back and hand over the business may seem simple, but actually, as I'm sure you well know, the consequences of failing to plan can be quite severe. We can often see family fallouts, feuding shareholders, or staff exodus, all common scenarios that can ultimately make your client's business unsellable and unmanageable. So let's start by getting our terms right, shall we, so we can then help the clients get their options right. Putting it as simply as I can, a succession plan identifies who's going to take over the reins and when, and it outlines interim measures to ensure that the successor is ready to take over. An exit strategy outlines how the business will be transferred to another third party, typically an acquirer. Family businesses face particular challenges in these areas, and your clients will be no exception, by the way. Handing the reins to the next generation is still the most popular aspiration, and yet only half of current owners with that aspiration believe that the next generation is capable of taking over. I think many of you, if not all of you, will know that I run the BCMS half-day events together with the CEO, Dave Rabetz. I mention it because we'll do 50 to 70 each year. It varies a little bit year on year. And if you've ever been to one, which I know a good number have, you'll know that I spend all the time I can before we start chatting to delegates. And it's an important conversation for me. And I can tell you, every single time, every single venue, I can guarantee you that in the pre-start conversations, this issue will come up. And let me tell you some of the reflections I get back from accountants in the room. The children of the current owners may be too young. That puts an unwelcome brake on the timing that the owner would prefer to work with. The owner may love their kids and perhaps in their heart at the emotional level be keen to pass on to the children, but in their intellect they may well be uncertain as to whether their children really have the necessary skills, the personal resilience, or commonly these days even the appetite. The owner, again, may face an internal dilemma. Do I hand this business on with the challenges that I already know about, or would I be better to sell this business and invest some of the proceeds with each of the family members to help them set their own businesses up? There may well be equally dysfunctional or partially dysfunctional relationships, and that too leaves the owner with a dilemma. Do I give it to all my children equally? Do I give it to one and leave them to sort it out? And you can see already these conversations are courageous if you're going to have them. And one of the biggest issues for your client, and one that probably only a church pastor, a trusted coach or mentor, or you as accountants can tackle, is to ensure that the client, the business owner, has faced up to the reality. If they pass the business on, whatever the legalities, they are still likely to face daily, certainly weekly, anxiety or concern about the impact of running the business on their own kids. So far from releasing the owners to a much less stressful life, in reality, in extremis, at least, it can make things even worse. Why? Because now, as the previous owner, you have worries about the business, but you no longer have the direct ability to control. Equally, non-family businesses face their own dilemmas too. They're different dilemmas, aren't they? But many SMEs remain overly reliant on their founding entrepreneur, limiting internal succession options, whilst also making the business unattractive to potential buyers. I was with one client some months back, an owner running a software as a service business who'd been approached by 4 potential acquirers. Stalling point for each of the 4 in the early rounds of negotiation was the young founder wanted to leave ASAP, and there's no COO in place. So for the acquirer, it was too risky. But actually, for the team, the client of mine, it wasn't a difficult thing to address. So in our time together, then, we're going to look at ways to address these common challenges that your clients as entrepreneurs will face when they seek an exit. Whether the business is to be passed on to the next generation, sold to a third party, broken up, or even closed down, takes careful planning to optimize the chances of success. And there is no one better to handle that question and that process than you. Now, we have 3 questions today, and I'm going to launch the first of our questions. These are all totally anonymous, by the way. But would you be kind enough to reflect on the first poll, which is approximately how many clients does your firm serve? And you just select one of the following: 50 to 150, 150 to 300, 300 to 600, 600 plus, Gosh, half of you have already filled it in. Thank you so much. If the rest of you would be kind enough to complete that, we'll then publish it, and you'll get a feel for how you sit along with today's other delegates in terms of the number of clients. Well over 3/4 of you have now polled. If I could encourage the remainder of you to just select one of those boxes, that would be fantastic. A couple more of you still to go. And I'll stop the poll there if you don't mind. I'm going to share the results. And 50% of you, 50 to 150, 28% 150 to 300, 12% 300 to 600, and 9% 600 plus. Thank you so much for sharing with us on that poll. So let's look next then, if we may, at succession planning itself. SP as the industry tends to call it. I mention it only so that if you hear the little acronym, then you'll remember what it is. Now, succession planning, of course, has been around as long as family businesses themselves. Historically, the family firm was often passed down to the eldest child, even if they were sometimes reluctant to take that responsibility. However, in the last 2 decades, succession issues, as you will have experienced, have become more pronounced, and that is due to several emerging realities. Firstly, job mobility. Few people want a job for life, so finding and keeping key people is harder, I think, as accountants. You're well aware of that, even in your own world. Of course, translate that or transfer that thinking into your client's world. Retirement. Now, this is a really interesting fact. Baby boomers are retiring in record numbers, which is going to increase the demand for senior management expertise in what is obviously self-evidently a diminishing pool at the same time. And then downsizing, that is the trend for flat management structures, has removed tiers of previously potential leaders from business infrastructure. Succession planning acknowledges that staff and shareholders will not be with the company indefinitely and provides a process to address the changes that will occur when they leave. And while most planning focuses on the more obvious CEO succession, all key positions should be included in a plan. So what is succession planning then? It's a process to identify and develop internal people to fill leadership positions in a business and other options as well, as we'll see. In practice, this amounts to holding on to a pool of talent, then planning replacements in key roles. Why is it important? 4 reasons. Continuity. It's a means to ensure business continuity when key people leave. It's a way of hiring and keeping talented people to stay in the business. That's retention. Motivation is the accompanying commitment to develop career paths wherever that's possible, because that sends a message to employees that they are truly valuable. And then value. Unplanned transitions typically reduce company revenues by 16%. I'm going to give you that stat again. And by the way, the sources for all these data points are in the book. You'll find the actual sources when you get your copy. But unplanned transitions typically reduce company revenue by 16%. Now, the first question you're going to address with the client is, who is actually responsible for what when it comes to succession planning? Well, it's very simple. The board is responsible for the CEO replacement. The CEO is responsible for planning replacements for the other key skills. And if the HR manager lacks the skill sets for succession planning, external consultants will need to be approached. Where do you typically help your client find these replacements? And just knowledge here in your portfolio of knowledge will really help clients. So existing senior staff, that's an obvious place to look, isn't it? But you have to look beyond the exiting executives' immediate deputies. You have to think laterally there and help your client to do just that. New hires, of course, exceptional employees in other organizations may well be looking for new challenges. Former staff, perhaps a manager left 2 years, 10 years, 5 years ago to gain more skills and experience, and maybe could be intelligently rehired. And then, of course, consultants. Consultants may well be interested in working as an employee again, but in the right environment. And often the easiest way to attract them is with a small amount of equity. Now, depending on the number and level of new staff required, different types of recruitment solution should be encouraged from you to your client. Don't just encourage your clients to use the more obvious recruitment agency, which is based on a percentage, sometimes 20% or more of 1 year's salary. It's incredibly costly. There are some great industry-specific options available that will do far more and do far better than that. Do also ensure you've done your local homework. There are all kinds of development grants available to help your client's company recruit. I was dealing with one client company recently whose accountant had alerted them to a development grant. And they now have 16 new staff hires approved by the Regional Growth Fund who've contributed 150 grand to those 16 new hires. That all came from a proactive accountant who helped my client understand what was available and then helped my client to make the application. And you might want to consider, is this a good value-added service possibility for you, helping your client right here? So I just typed in Regional Growth Fund. You can do it in your locality, and you'll see there's 3.2 billion available in total across the UK. And don't forget to use LinkedIn and get your client to use LinkedIn, and check for recruitment alternatives. Now, in succession planning, what do business owners typically do next? Many owner-managers are daunted by the prospect of having nothing to do. I had this yesterday in the seminar in Prestbury. A 75-year-old gentleman running a very successful business, and his concern, he could see the importance of considering exit. His concern was, what do I do? And I was able to help him very quickly on that, because typically owners have given so much of themselves to the business that they struggle to let go and create some separation. So no wonder then that 30% of BCMS clients who are entrepreneurs will start another venture. They'll get into crowdfunding. You can see the average age of shareholders below on the chart. We'll come to it in a moment. But Anthony Flynn of Investec Wealth says most of these people are hardwired as entrepreneurs, and they're either looking for ways to spend time or make money in new and innovative ways, and that just simply doesn't go away. So lots will use their newfound freedom, as you might expect, to help their favorite charity or pass on their experience to other business owners. Philanthropy is a growing trend in the slightly older end of the demographic you see on the screen, particularly for those who are in a relatively wealthy position now where perhaps their own childhood was not so privileged. There's also a growth in mentoring by people who've successfully built a business, and typically this will be motivated by altruism rather than by profit making. And you've got some interesting stats here taken from 100 selected businesses. So average age of business, 3 decades, average number of shareholders, 3, average age of shareholder, 52. By the way, that is always dropping. What I mean by that, the average age of the exiting shareholder is not getting older, even though we've got an aging population. It's getting younger. More people want to consider their options earlier. So that's an interesting thought to ponder on. And then here is a succession planning checklist. If you'd like this as a separate piece of collateral, if you just want to type checklist really quickly in the question panel, I'll make sure I get that to you later today. And I think this will be a great conversational agenda piece, don't you? Sitting down with your clients, succession planning checklist client, let's go through this together. Set goals and objectives, identify preferred exit strategy, maybe restructure shareholdings. Worth you having a look at shareholdings with your clients, making sure there's nothing there that could be a niggle when the time for exit comes. Tax and legal implications, you'll be brilliant, of course, at that. Estate planning, you'll be brilliant at that. And then helping your client think through successor selection, successor training, having a contingency plan, thinking about conflict resolution. If there are multiple shareholders, it can be that shareholders have very different interests, very different aspirations, and very different views around exit. So getting hold of that early is a real important ingredient in the checklist planning, and then looking at timelines together. Again, if you'd like a copy of that checklist, just type checklist in the question panel. I'm going to launch the second of our 3 poll questions, if I may, and here it is. How aware do you believe your clients are of their options when it comes to exit? And you just select one of the following: highly informed, marginally informed, not informed. And let's just see. Remember, these answers are strictly confidential, and let's just see what our aggregate result today is. That's brilliant. A few more of you just remain to fill in the poll. If you'd be good enough to do that, that'd be fantastic. Brilliant. I'm going to close the poll there and then share those results. 70% marginally informed, 30% not informed, and nobody highly informed. So I think whatever else we might make of that, I think what it tells us is that we've got a great role to play, and actually there's a huge opportunity for us to play that role. And probably no one else is going to do that for our clients. So is a business still sellable then without resolving succession issues? Small study, 100 businesses, found that 58 had no succession plan. Furthermore, these owners were not required to stay in the business after acquisition any longer than those with successors in place. Conversely, a slightly larger study of business transitions found that unplanned change of ownership or management caused a 16% drop in company revenues and a 4% drop in annual profit. So 2 interesting little stats again, which will be available as source material from the book. So exit strategies like succession planning are important in terms of choosing the right exit strategy for the business owner and the shareholder. And that's going to take careful planning, and it's going to take good advice. How do you help your client prepare for exit? This is another checklist. So if you've typed checklist in, I'll make sure you get both. You've got to encourage your client to assemble the best management team possible. The owners will step back gradually from the business. You're going to plan the tax situation with your client. You're going to make the business as attractive and investable as possible, profitable, growing, well-run, all things that you're well-suited to do with and alongside your client. And then help your client to add as much substance to the business as possible. Things like trademarks, contracts, R&D, and so on. Now, what are the options then? Well, there are at least 6. There are more, but there are 6 kind of classic options out there. First of all, an IPO. That's an initial public offering, where a portion of the company is floated on the stock market with public share trading. Typically, the owner and the management team here will remain in place for a few years, and the company continues to operate much as it has in the past. Now, most major financial centers have secondary stock markets designed for smaller businesses. Believe it or not, there are actually no minimum size requirements, and companies with as little as 20 million annual sales are trading successfully. Pros: very straightforward exit for a shareholder or investor and a great capital injection for the business. The cons: the public companies are subject to additional regulations which can be prohibitive. And I know too, for ICPA members, the bulk of you have clients that would be nowhere near the size that I've described, even at the low end of that. So much more likely for an ICPA member's clients would be the full company sale. Selling the entire business is a very popular choice among family businesses and entrepreneurs. 90,000 acquisitions in total last year, globally of course. The acquiring company buys the assets and or the shares of the target business and may or may not wish to keep the current owner or management team. Most buyers will structure the terms of a deal to keep the business on board for a handover period, and ideally, if your client wants out, not all of them do, by the way, you'll want that as low as possible. So typically 1 to 2 years, often attached to a deferred payment or earnout. The positives: realizes significant cash to fund retirement, to start other things. The negatives: loss of control on the future direction of the business, which may still have friends and family involved. A partial sale, by the way, has a really interesting dynamic to it. This is where typically you would encourage your client to offer a majority stake. There may be very rare exceptions when a minority is preferable, but a majority stake is generally preferable because your client will get a premium price for his or her business. You're giving a controlling interest away, in other words. So another company takes that stake, either indefinitely or for a fixed period, allowing for board-level exit eventually whilst providing stability to the business. In the book that I know many of you have from me, called I Sold Up, Chapter 4 is about Carl Robinson, St. Anne's Contractors, and he exemplifies this. Carl was effectively convinced his company could grow much further than his resources and skill set on their own could achieve. So he did exactly what we've described here. He sold, in his case, 70%, so a controlling share, by choice. That was his intention all along. Carl stayed involved with the inbound acquirer, and together with that acquirer has been responsible for growing the business way beyond where his own resources would have taken it. And that may well be something it would be wise to consider with 1 or 2 specific clients. And then a common default setting, which is often a dangerous default setting, but not always. The management buyout. It's called an MBO, as I'm sure you know. This provides an immediate cash payment to the existing shareholders as the business is recapitalized, if you like, and sold to the next generation of incoming management. And an MBO is usually financed through a combination of private equity and debt, which is collateralized against the assets. Investors, bizarrely, like MBOs because they provide consistency of management, less disruption to customers, staff and suppliers, and of course retains in-depth industry knowledge. So the pluses: buyer and seller already know each other. The negative: the occasional inability of financial partners to agree on how they will deal with each other. But there is another negative, which I'll come to in just a moment, and you may well have guessed it, of course. But before I go there, let me just give you what we call the MBO myth buster. How are MBO deals financed? Venture capital, private equity, business angels, and asset-backed loans. Aren't these deals risky? Well, a well-structured MBO takes account of any performance shortfalls while still meeting the funding obligations of external investors. My managers don't have enough money to invest, and for me, this is the really critical con, the negative. Typically, a figure of 1 year's salary will need to be personally invested by the management team, but then, of course, they've got to borrow the money. And the reason I am particularly inclined towards the negative as a general rule of thumb is whoever loans the money ultimately controls the price your client gets. That's the big issue for me. How long does it take? Typically 4 to 6 months, considerably shorter than most trade sales, which average 12 months. So before I take you into a management buy, let me just tell you a story which kind of exemplifies my concern. July 2006, company was the subject of a management buyout. 2 managers bought the company from the founders for $500,000. In January 2007, those 2 managers came to us at BCMS and said, "We bought the company for $500,000 last year. Can you sell the business for us?" And we'd sold them by October 2007, and we sold them for $23.5 million. So they bought the company as an MBO for $500,000. 15 months later, they sold it for $23.5 million, they hadn't even paid the former owner his full $500,000. How good is that? No. Of course, how shockingly bad is that if you're the previous owner? I don't know whether they ever did actually find out. It's the kind of thing you hope to goodness they never did find out. So the MBOs that fail by and large because as employees, they don't have the appropriate funds. Management buy-in sounds similar, but it's quite different, is when a management team from outside the company either have or raise the necessary finance, buys it, and then takes responsibility for the new management. Just 2% of business sales globally end up as an MBI. And the challenge here is the incoming team has to appeal to both the exiting shareholders and their investors in order to successfully complete the transaction. The positives, well, it's ideal when there's no single succession plan and no obvious internal candidate. MBI candidates may have some profile in the industry which could help unlock other future potential. Cons include the occasional risk of clash with new management, company culture, direction, strategy, and aspirations. And then liquidation. I suppose this is by and large the least desirable option. The Family Business Survey in the UK and Europe suggests that somewhere between 10 and 15% of business owners will simply shut their business down at the end of their working life. And here the challenge is that business owners may not appreciate the true value of their enterprise and simply seek to sell off stock and assets piecemeal. Well, positives, it's an emergency plan if the other options fail. As accountants, of course, you'll be much better placed than me to understand the tax benefits, but I understand there are some significant tax benefits of a voluntary liquidation at least. And then the negative, significant loss in value from not monetizing the soft assets. Really important here for accountants to help their clients optimize the realization of assets. And then let's take a quick glimpse at what today's sellers look like. 37% you can see here are entrepreneurs, 31% husband and wife, 15% only intergenerational, 11% siblings, and then a little bit left in the last two bar chart elements there. What does the client demographic look like? And do bear in mind, as I said earlier, that the average age of exit or aspiration to sell is decreasing. So you can see quite a large chunk here in the age 45 to 55, another large chunk 55 to 65. Under 45, small but significant chunk, and that's a client demographic that may be interesting. Let me take us to our last poll and then take us into a couple of short stories before explaining exactly how you can benefit as an ICPA member from the partnering scheme. So over the next 12 to 18 months, how many clients do you estimate will be ready to explore exit options? How many clients do you estimate will be ready to explore exit options? None at all. 1 to 5, 5 to 10, 10 plus. Thank you for responding so promptly. Brilliant. Let me close that poll. Let me share those results. And what an interesting spread. Most of you think you've got 1 to 5 clients, and I think that's a fairly realistic judgment. Just a few have got over that. Let me make sure I hide those results, get us back to our slide. So a couple of examples, then I'd like to share the very positive partnering arrangement between ICPA members and BCMS that's available. Husband and wife, John and Jane, both 50, set up a food logistics consultancy 2 decades back, and they put in place some informal succession planning by offering a board position to a senior manager some 2 years back. They had doubts about his ability to run the entire operation, and after hiring an advisor, the couple decided to see if they could find a trade buyer to speed up their exit, with a possible management buyout as a fallback position. They sold for $5.6 million to a multinational logistics group who had put one of their own managers in to work alongside the previously identified successor. So there's a solution, if you like, to the wrong successor. Number 2, unfortunately, all too common, an unexpected breakup. Bill and his wife Barbara had run a retail business together for 15 years. They were getting divorced. They'd agreed to split everything 50-50, but the breakup had taken its toll on the business. Sales were underperforming. After looking locally for a possible investor to buy out Barbara's share, they decided to sell the entire business. They had no succession plan, were in a hurry to sell, but their advisor found them a major retail group keen to expand geographically in their part of the world. The $1 million offer was accepted by both, and as a cash-on-completion deal, both parties were able to walk away and start a new chapter in their lives. However, their aspirations had to be managed, as you can imagine. The reluctant entrepreneur, David, started working for himself as an IT consultant after the recession in 2008, took a few customers to get the business going. Regarding himself more as a techie than an entrepreneur, he hired 2 managers to take on the commercial and the operational aspects of the business. After 6 years, found he wasn't enjoying his work and wanted to start a new venture in a different field. And despite his apparent reluctance, the business was growing at 15% a year. It attracted, as you might imagine here, multiple buyers, multiple offers. He eventually sold to a private equity house who wanted to combine his company with a similar IT consultancy they had purchased the year before. David started up a new venture in a new non-competing field, busy developing a new suite of products. Number 4 is selling a cash cow. Brothers Andrew and Adrian set up their software business in 2010. Runaway success, as it was, generating double-digit growth. The pair awarded themselves generous salaries and dividends, and sales were robust, attracting a good number of private equity investors. They worked out what the business was worth and believed it was time to cash in, but on closer inspection, the investors dropped out when they saw how much money had already been removed from the business. And that's worth keeping in mind with your client conversations. Eventually, Andrew and Adrian found a trade buyer and accepted a $10 million offer. The buyer himself told them afterwards they would have paid at least twice that if the brothers had reinvested half of what they had taken out of the business. So a little warning, or if not a warning, perhaps a perspective that might just focus us when sharing with clients. So summarizing what we've seen about succession planning and exit, succession planning and business exits are 2 important, equally important elements of deciding when a business should or could change hands. Succession planning is an ongoing process to identify and replace key people, not just the owner-manager. An exit strategy can also be open-ended, but is more often fixed by a range of factors like market conditions and the age or health of those exiting. And as we've seen, there are 6 or more deal types to deliver the goal of a succession plan or a business exit. And whilst some are more popular than others, it's important that owners enter the process of transitioning their business with an open mind. Now, a question that your clients will ask you, I can guarantee it, and a question which I'd like to address before finishing up with the partnering process. For the vast majority, the future of their privately owned firm, your client's privately owned firm, lies in succession or sale. Ultimately, employing a manager to run the business while you exit or do lots of other things has its own dangers. And of course, this is a subjective issue, and that's the challenge, because The reason is this is not so much about whether the company is ready, but more to do with what is right for the shareholders themselves. And if you think about it, it becomes obvious that in some ways your client's company is never really ready for sale. There's always one more contract that they could get in the bag. There's always one more high-end recruitment they could make, or that one more year of profit to get behind us. And inadvertently, a client can leave little on the table for the acquirer to improve. And bizarrely, perversely, that can reduce desirability. So as is often the case, it will come down ultimately to what is right personally for your client. But there are three macro factors. Firstly, the amount of cash on balance sheets right now globally is at an all-time high. Japan, 70% up. America, 30% up. General Electric, 85 billion alone. Apple with more cash than the Greek economy. And shareholders all over the world are calling for their executives to use that money for growth, which in turn means there's an unusual appetite in the last 12 to 18 months for acquisitions that we've not seen in 28 years of doing mergers and acquisitions. So the point I'm making here is it is currently a seller's market. How long that's going to remain, I honestly can't tell you, but that is a fact. Entrepreneurs' tax relief means your client will keep a good percentage of the sale proceeds. Every year there are rumors that it will change. Will it? Who knows? What we'd all agree on, I think, is if it ever changes, your client's not going to get more in his pocket. He or she is going to get less. And then, of course, baby boomers. In the next decade, the baby boomer generation reached retirement age last year, so the number of companies coming on the market is set to change dramatically as the baby boomer generation retires. So what is currently a seller's market for both cash reasons and baby boomer reasons is likely to become a buyer's market. And that's really all the advice I can give you. What I could add is this. I have spoken to hundreds, probably thousands, in my life who've sold a business. I can't remember anyone ever regretting selling too early. But I could tell you some very sad, deeply sad stories in some cases of those who left it way too late. That's a conversation, ladies and gentlemen, you're going to have with your clients. Now, as an ICPA member, the BCMS partnering scheme has been put in place, which simply means if you want to introduce your client to the BCMS model of selling a business, you're entitled to free seminar places for clients. Good number of ICPA members have already attended those to get a feel for what their client would experience. A free business evaluation and succession planning consultations for you and your clients. All this is free. And please don't assume that your client is just too small for the BCMS process. I had an accountant call me. He said, I think my client's worth about $250,000, and I think they're just too small for the BCMS process. So my question was, what technology, or rather what sector is your client in? And the client's turnover was $500,000. The client sector was technology, and the BCMS consulting fee at first glance seems really too high. But actually, a few months before this call, a software company with just $250,000 turnover had sold ultimately for $740,000. Whereas if the accountant had been talking to me about a Luton-based printer, let's say, with a turnover of $450,000 with a 20-mile radius, the answer would have been no. So don't assume, please do ask. And then Tony Margaritelli himself and a number of ICPA accountants have said to me, we've got a lot of clients who are sub 1 million. Can BCMS do anything? And the answer is yes. There is a new service, I say new, it's a year old now, for companies with less than $1 million turnover. It's called BCMS Lite. And the lowest I think we've taken on so far is 150,000 turnover, more commonly around the $500,000. And the costs there are much less. The base fee is just $15,000. The success fee, as you'd expect, of course, is higher. There are no partnering commissions or payaways available for this light program. Now, there's loads of resources, and we're nearly out of time, so I'm just going to glimpse a few of these and then wrap up. There are hundreds upon hundreds of case studies. So if you've got a client in a particular sector, the first thing to do is just go to the BCMS website, use the search engine, and you'll get almost certainly a case study that's relevant to the client's size and sector that you're considering helping. Don't let your clients leave it too late. Use the copy of the book that you'll be sent shortly as a trigger for conversation. I'll send you a PDF version so that you can send a PDF copy of that book. And then it starts with identifying the most appropriate clients. And my encouragement, if you'd allow me to suggest this, would be when we finished, in just a moment or two, take a couple of minutes and identify, I think, was it 70% of us said we've got between 1 and 5 clients that could be considering exit. Think of those 1 to 5, but do it. Write their names down, think about it, and remember that the pay-away part is really substantial. So for every client you refer to BCMS that ultimately goes ahead, there's an absolute number. In other words, the referral pay-away is $3,400, and then there's a very generous 10% share of the ultimate success fee. So I had a partner introducing a client just a year or so back, ultimately sold for $4.5 million. The referral payaway and the share of the success fee for doing nothing other than just referring was just over $8.5 grand. And then, of course, you'll put your own numbers here, but what other value-added services would you then offer that client? Maybe funds under management, referring them to a wealth management, new start, pensions, compliance work. It's going to add up, and you'll put your own numbers in there, of course. But over time, it is quite possible to add, let's say, for smaller clients, 5 to 10 grand. Certainly for larger clients, maybe 10 to 20 grand on the gross recurring fees. Now, the simplest way of doing this, and it's the way 95+% of all accountants in the partnering scheme do it, is to invite all or some of your clients to an upcoming BCMS half-day event. I've myself committed to presenting at these events with Dave Rabetz, the CEO of BCMS. You can simply attach this PDF invitation to an email and invite your clients. The next one's coming up. You can see on the screen Dartford, Edinburgh, Nottingham, Liverpool, Southampton, Leeds, Cambridge. That's the remaining seminars for this year. Totally free, no sales pitch, high content and high inspiration. Your clients will leave that ready to have a great conversation with you. And one other idea you might just want to consider. Cognitor, HSC, Mark Holtz, Tyre Barley, Tomlin, and others. They've all asked, David, could you come and talk to my clients and do the BCMS presentation to my clients? And the answer is yes, and we'll do it free of cost. The only thing we ask for you to do is to get the delegates into the room and cover the costs of the room itself. Graham Eden from Cognitor, he sent a simple email out. 23 delegates turned up, including 6 non-clients. So now he's got 6 non-clients he can sell his accountancy services to, and of course long-term interest for referrals for exit. So if you're interested in a jointly hosted event and you think you could get 25 appropriate clients in a room, it'll only be 1 or 2 of you. But if you'd like to explore that, we'll give you the email templates, explain how it works. So if you'd like to know a little bit more about that, just type seminar details, if you would, into the question panel. So wrapping up, remember the next step is for you and clients to attend an upcoming event. I'll make sure we ping you a copy of the agenda and the dates. And please do remember, if you'd like a copy of the book, type book please into the question panel. That's me done for today. Thank you so much, Tony Margratelli and ICPA, for inviting me to share this material. And thank you so much, everybody, for joining me, David Oliver, on today's succession planning and exit planning event. Take care.